I think the sort of first thing that I think most people think about, or the first question when you're thinking about financial markets, is whether they're efficient or not, whether they incorporate all known information, if it's possible to do sort of significantly better than the market as a whole. And I'm not sure. Used to be absolutely received economic wisdom that financial markets were efficient. Now it's I think it's still the dominant academic view, but there's a big debate, and there are partisans on both sides. It's actually, to me, it's actually a fairly simple question. The notion that markets are efficient derives from an a priori theory, which is the same sort of theory about all markets. There are lots of incentives, people acting in their own interest. They have to do that. It's a very appealing kind of a priori theory, but the thing about theories is they're supposed to make predictions, and if some of the things they predict don't come true, the theory has to be disregarded. And there are many counterexamples to financial market efficiencies. Sort of on one level, there are things like companies that have two different classes of stock that are economically identical. So Royal Shell used to have Dutch shares Dutch shares that traded in Holland, and UK shares traded in London, economically identical, but their prices would fluctuate and fairly dramatically. In '98, I forget which way, but one of the share classes was at a 20% discount to the other, and that persisted for several years. So you have economically identical things trading at different prices. You have closed-end funds, which are vehicles that own a set of other securities, trade as a security, listed on the stock exchange, but what they do is own other securities. And whether they trade to a discount, whether the security in the closed-end fund trades at a discount or a premium to the stuff they own, fluctuates meaningfully in a way that's sort of difficult to recognize, with the idea that the security should be reflecting economic value. You have what are called stubs, where one public company owns a significant stake in another public company, and in instances where the one 3Com owned Palm, and the value of its Palm stake greatly exceeded the total value of the market capitalization of 3Com, and that persisted for a number of years. In general, less volatile stocks have done better over time than more volatile stocks, which is somewhat inconsistent with the notion of efficient markets. And lastly, there are a meaningful number of individuals and institutions whose sort of performance whose performance in portfolios is really inconsistent with the markets being efficient. It can't really be explained away by some of them can, but by luck or by inside information or by something. So while there's sort of a big academic debate, and then lastly, there are things like the internet bubble, more recently the housing bubble, or not usually called this, but the lending bubble, or the subprime mess, or so forth. Lots and lots of security loans, securities that people bought at par that were worth about somewhere between 0 and 15 or 20 cents, and now trade there. So I don't believe that markets are efficient, and it doesn't really seem like it should be an open question. So the people that believe it have to die, and then nobody will believe it anymore. Not very many of them change their mind, though they come up with more convoluted explanations. Clever, convoluted explanations for the counterfactual, for the things that happen in reality that the theory doesn't predict. So markets aren't that efficient. On the other hand, sort of doing better than the markets is a non-trivial exercise, and it's not as easy as it might appear, or as I mean, some people think it's impossible, other people think it's really easy. It's actually not impossible, but hard, and there are a number of challenges. First, for individuals, I think the primary challenge is if an individual sticks to sort of areas where they might have an informational advantage, or at least don't have an informational disadvantage, they won't own a diversified portfolio of securities, because their informational advantage will be narrow. They also have sort of limited access to the gamut of products and so forth, and restricted assets and restricted access and restricted offerings. So that's a challenge for individuals. Institutions or sort of professional investors, all spend a lot of money on information, and which requires infrastructure and resources and so forth. But the very sort of nature of being an institution constrains almost everybody, whether it's in our case, all our investors have 30-day liquidity. In mutual funds, it's daily liquidity, but their investors tend not to be as wide awake. But that's a constraint on us, is that except for the principals, maybe their families, maybe not, all our money can disappear in 30 days. So we have to be cognizant of that. We have clients that have sort of a set of expectations, which you also have to, if not be cognizant about, sort of deal with. And then there are kind of universal sort of psychological challenges, biases in people's thinking, and a number of things that are just sort of difficult for human beings to process and make intelligent decisions. And I think this is that's kind of an area of mine, and one of the things that drew me to Professor Schiller and some of his other colleagues. And that's really universal, to not just financial markets, but to all decision making. And I think sort of particularly in the kinds of things that have a serious mix of randomness and skill. That's sort of the hardest thing for human beings to process, is something that's kind of an unknown mix of randomness and skill. People, we can understand something that's fully random and work out the statistics and be comfortable with that. To some degree, things that are sort of completely cut and dry, fully determinative. We like that too, but stuff that's mixed is very, very hard. I mean, quantum mechanics makes sense to no human being, in my view, and in those areas, people are inclined to do sort of strange things. I mean, one thing. I play a fair amount of I play a little bit of poker, and I'm very interested in the game. And it's a little like the markets and other things, in that there's an element of randomness and an element of skill. One thing that's I find interesting, typically, if you play poker in a card room or a casino, I would say 9 times out of 10, somebody sitting at the table will tell you that they're not trying. It almost always happens. They'll say, I usually play for more money, and it's hard to concentrate, or I'm just screwing around. Sort of why do they do that? Why do they not? They could just be screwing around, but why do they tell you? And it's kind of my pet theory that they would rather they're setting up in advance to lose. They would rather lose because they're sort of screwing around than that's easier for them to sort of deal with than to they could put out their best game. And they would do better, but they might lose anyway, given its sort of randomness, and it is that's the thing about really good poker players versus less good poker players. Really good poker players play close to their best all the time, and they're not really bothered when they lose, and I think that's that's true in markets too, and all sorts of decisions. What people are inclined to do, or are very interested in doing, is setting up, posturing for credit and blame in advance, and sort of having a pre-made excuse if things don't go right. They're interested to some degree, at least, in having an excuse if things don't go right, than in sort of maximizing the chance that things go right, because even maximizing the chance that things go right, you can't get it to be 100%. There's an element of randomness. Bad things can happen. So it's really, really hard to just focus on getting things right and not winning the argument, setting yourself up before the fact so that you can win an argument after the fact that you didn't, you just got unlucky. People are very inclined to see things as determinative, to sort of to attribute, and that not just in markets, but in the psychology literature, to believe if you're wired to believe if something if A happened before B, A caused B. B has to be caused by something, and A happened first before it. So that's what. So they assign causality. They're also inclined to focus on sort of recency, sort of things they see, even if they are irrelevant. For example, in the psychology literature, famous example is famous kind of test question is a tester will give the person taking the test the name of two cities that they've never heard of and the distance that they're apart. So two random cities, XYZ and ABC, are 4,200 miles apart. And then they'll give them two other cities that they've never heard of and ask them how far apart they think they are. And people anchor to the information they were given, even though there's kind of no causality or no sort of reason why it should make any difference. So if the reference cities, the first cities, are 4,200 miles apart, the answers for the next two will center around 4,200 miles. And if the reference cities were 2,500 miles apart, they'll center about that. It is. I think it's useful to sort of know all the hardwiring biases and that people have, and to try and debias your thinking. But it's not easy, and in lots of cases it's not actually people's objectives. If any of you watch Mad Money on CNBC? Jim Cramer? Any Kramerites? Nobody? Well, he starts his show. Some people want to make friends. I just want to make money. And if you watch the show and you see Cramer, it's pretty believable. I think it's true. Almost everybody in sort of financial markets is capable of saying that. I don't want to make friends. I just want to make money. But for most of them, it's not true. They have all sorts of things that they want to do other than make money. They have office politics. They have any number of other motivations, and that psychology is really hard and somewhat applicable to not just markets but other things. So markets aren't efficient, but it's not that easy to beat them. So what do we try to do? I kind of would highlight what I view as three sorts of principles. The first, the investment world, I believe, divides between coupon clippers. Bonds historically came with coupons. Actual sort of coupons like the thing you bring to the grocery store, and get 25 cents off a can of coffee. So we have this security, and a 10-year bond would have 20 coupons attached to them, each with a date on them. And when the date came, you would cut the coupon off and go to the bank and get your interest payment. So that was called coupon clipping. Basically, something that coupons are things that you redeem for a stream of money. And in my view, the world divides between coupon clippers, sort of people that are interested in cash flow and taking in cash flow, and what I would call security resellers, people that own things that they intend to sell to somebody in the future at a higher price. And there are successful coupon clippers and there are successful securities resellers, and they tend to make their money off of off of the unsuccessful people in the other class. We try to be, I think sort of investing is about clipping coupons, about getting cash flow and getting and controlling cash flow. But there are good resellers, and I think reselling is an element of things like venture capital. The best venture capitalists don't just have great ideas or whatever, but they take an idea, they advance it a little bit, and then they sex it up and promote it, and have a good sense for what the public will buy, and they get a nice valuation from the public. And I think that's at least as much a distinguishing feature between good venture capitalists among each other than the quality of their ideas. There are sort of Kramer again. Kramer was a good security reseller. Had sort of a really good, spent a lot of time and effort, kind of figuring out what is it that people will want to buy next week, and that's what I'll buy today. Not because I'll derive income off of it, but because it's what people are going to want next week, and I'll be able to sell it higher. And that's some art, some science, and there are people that are very, very good at it. But we try to clip coupons. As does it's a Warren Buffettism. He says all investing is about coupon clipping, and the difference between equities and bonds are that bonds come with a coupon that's known, and equities have earnings in the future that you don't know. You also don't know that they'll give them to the equity owners and not to management, or they won't squander them in the future. But to Buffett, it is sort of the same thing. It's clipping coupons, and he describes his job as figuring out what the coupon is in an equity, and if it's high enough, he likes it. So the first sort of principle to me is clipping coupons. The second is that risk is primarily about what is the worst thing that can happen. In typical sort of Wall Street risk management, a lot of focus is on what is the range of moderately probable outcomes. So people talk about VAR, value at risk, and lots of people try and build VAR systems, and what they are trying to determine is how wide is the band of outcomes, how wide is the band of stuff that has a 95% probability or a 98% probability, usually 95 or 98, but not 99.9. And if I have a 98% chance of not losing $1, that works in the VAR screen, and the VAR, and it won't tell you, well, won't distinguish between whether the 2% chance is of losing $10 or losing $100. And to me, that's a fundamentally wrong approach, and it's actually done because it's the sort of thing that statisticians are good at, and to some degree, it's harder to imagine the worst thing than to statistically sort of figure out the middle band. And there's a famous saying: if you're good with a hammer, everything looks like a nail, and that's sort of what that's like. But the really important thing is what's the worst thing that can happen. And the last sort of principle, which is actually most at odds with sort of the academic community and even sort of the general perception, and that is that you don't get paid for taking risk, you get paid for eliminating risk. I actually believe in the history of the planet, there are very, very few instances of people getting paid for taking risk. They get paid for eliminating it. As an example, if you think about a tightrope walker in the circus, there's a conception that he gets paid because it's a risky job. He might fall, he might fall down, kill himself. I think that conception is completely wrong. The lifetime earnings of a tight wire walker who falls down and kills himself aren't very good. And in fact, what he's getting paid for is that he practiced a whole lot when he was a little kid on a wire that if he fell off of, he wasn't going to get hurt. And that he's really getting paid for eliminating the risk of falling off via practice as opposed to taking it. You think about drug development, pharmaceutical companies, and people will say, well, discovering compounds that are effective drugs is an uncertain, risky business, and that's so pharmaceutical companies are able to make, sort of get paid for taking that risk, and I don't think so. I think they get paid for applying intelligence and not testing every, not for the compounds they test, but for the ones that they've eliminated testing for, because they know, because they understand the chemistry or a disease process, and have some idea what sort of compounds are more likely to work than others. When I don't know if he remembers this, but when I last sort of explained this to Professor Schiller, he said, "Well, what about insurance companies?" And I said, "Proves my point. The sort of exact case. An individual, has risk of certain bad things happening. If the insurance company has risk, it's because they've made a mistake. If they're sort of doing their job right, they're actually diversifying away all the risk and relying on the law of large numbers. So a casino, does not have a risk that the law of large numbers will be repealed and a roulette table will be a long-term losing proposition, or a craps table will be a long-term losing proposition. they have risk that their overhead won't cover it, or that they won't have, their risk is that a steady stream of people won't come and be making a steady stream of bets at which each of them has a slightly negative expectation. So we really want to think, whenever we look at anything, what kind of coupons can we extract? What's the worst possible thing that can happen, and how can we eliminate that? And we do that. Sometimes it's by diversification, having a lot of sort of independent sort of bets. More times, it's having an offsetting kind of position where we're long one security that issued by a company and short something else that we think eliminates our risk. So a common kind of position will be long a high-yielding bond, bond that yields sort of 15 or 16 percent, and hypothetically, a bond trading at 60 cents on the dollar with an 8% coupon, 5-year bond that's yielding about 18%. Maybe the company has a $15 equity price, and we'll be short 15 cents of the equity, and which we'll try and keep all the way down. If the stock's $20 and we could stay short 20 cents worth of stock all the way down. If the company went bankrupt, the company goes to zero, on our short position we'll have taken in about $60, which is what we owned the bond for, what we paid for the bond. We have a superior claim in bankruptcy. We'll recover something, and in the meantime, we get this 8% coupon that we get to clip. So that's coupon clipping and risk mitigation. Now there's the other side of the stock going up, and we have to think about how much that can cost us, and whether our coupons are enough, and whether the difference between 60 cents that we paid and the 100 that the bond matures enough is apt to cover that. But that's the sort of thing we do, and it's coupon clipping, and it's risk mitigation or risk elimination. Fairly short. The last thing I thought I'd talk a little bit about is what's happening in the world today, in the financial system today, which to us, if you're in trading and investing, kind of all, sort of things happen in your world, and they're just unbelievable. And you go outside, and you talk to people that have jobs and lives, or go to school, and they're completely unaware that they're absolutely, they have absolutely no idea that this really amazing, unbelievable thing just happened. So like there's a shortage in hard red winter wheat, and Minneapolis wheat has gone from kind of 10 to 24, now back to Now to about 18 or 20, but in one day it went from 20 to 24 and a half, a 22% move in Minneapolis wheat, and most of the people in the world, had no idea that had occurred, and it makes absolutely no difference to them. Well, one of the things that's sort of happening in the world that's sort of central to the people that look at it all the time, but of maybe less direct relevance to people that have everyday jobs, is that the banking, more so than, I've been at this for 30 years, and in those sort of 30 years, there have been lots of, sort of mini crises and violent moves up or down, dramatic squeezes or liquidations, but more so than any time in the past 30 years, the banking system is really closed. The big American banks are not functioning. Their doors are open and people come and go every day, but they're not really open for business. They're neither making loans nor selling the loans they have, and it's it is starting. It's affecting sort of the fringes of corporate America now. Not yet. All of it, and it's what happened in Japan. I don't know, from 90 to, is it over in Japan? Maybe or maybe not. They usually just talk about it as the lost decade. Where Japanese banks were not liquidated, but they were not really in business, and that's happened now, primarily as the result of losses in now all mortgages, but mortgages and levered loans, and in my view, the Fed has dramatically cut interest rates. We started from 5% to 3%, but 3/4 of it, a quarter at a time, every Fed meeting, Fed meetings are generally about 6 weeks apart, but then 1 1/4 of it within a 2-week period, from 4 1/4 to 3, and they're talking about looks like they'll go from 3 to 2.5, whatever what's the next Fed meeting? Within a couple of weeks, and the markets are saying they're going to go all the way back to 1, which was the low for short-term rates. Purported, to some degree, they say their objective is twofold: to spur economic growth as the credit crunch sort of slows economic activity. And also, I mean, kind of independently or complementarily as a corollary to that, to free up the financial system and to help financial institutions. It's kind of my contention that it's actually hurting financial institutions. It's actually having the effect of not letting the markets clear, and it's nature of financial. Well, I mean that when I was explaining it to Professor Schiller, he said he didn't quite follow it, so I probably shouldn't try it. And he knows more than I do. So, but it's a very interesting time in that we're having a bit. We have consumers under pressure because of their overextension of credit, and they're having overpaid for houses over the last handful of years. We have kind of a slowing economy, either because of that or because the economy kind of slows every once in a while. We have financial institutions under stress or duress, and unlike sort of the previous time, we have headline inflation of 4.3%. I think it's higher. I think lots of economists think it's lower, but it's quite. Headline inflation is higher than nominal interest nominal interest rates. We have a very weak currency. The dollar has gone from buying a little over €1 to buying 2/3 of a euro in a couple of years, and 130 yen to 100 yen, 1.5 Australian dollars to a little over 1, and the there and in that scenario, there are more problems than policy tools. So anything, any policy action has downside, which makes it an interesting time. So about half the time. So questions? There's that.
You mentioned that markets are inefficient. Do you think that they're inefficient with respect to a price reaction? For example, do you think they're more efficient in positive price changes rather than negative price changes?
Can you repeat the question?
I think that the question is, sort of whether markets are more apt to overprice versus underprice, whether they're more inefficient when things are going up or when things are going down. I don't think I have a systemic sort of view. I mean, lately they've been more inefficient. In my view, because the Fed's creating too much money, but in recent years, there have been more examples of things that are priced too high than things that are priced too low. but there are both, and market makes mistakes in both directions.
I have two questions. One, do you think an individual investor should listen to Kramer? And two, what do you think are the best ways for an individual investor to make the best return in the market these days?
Again, this is something that I think Ben Stein agrees with, but just about nobody else. I think for individuals, instead of thinking of I want to have a portfolio, I should have a portfolio and I should be invested all the time, and I should divide it up, cash, stock, and bonds, depending upon how old I am. I think people's default position should be cash. Individuals' default position should be cash, and they should only make investments if there's really if they can see a really compelling case, and over the course of time, fairly compelling cases do come up, and they're not and individuals are in as good a position as professionals to see that. So sometime in your lifetime, stocks, equities as a group will be cheap by sort of most of the standards that have worked in the past. So Professor Schiller, in his books, he's got current multiple of trailing 10-year earnings. Good measure, sort of takes the cyclicality out of earnings, and you can see over history how that multiple has varied, and you've done very well. You've done poorly if, for the most part, if stocks have done much better if you've bought them at a point that looks cheap on that graph than one that looks expensive. And sometime in your lifetime, you'll get an opportunity for stocks will look cheap on that measure. They'll probably at the same time look cheap on a price to book basis, on a dividend yield basis. That they tend to move together, and you can sort of look at them and say, equities as a class are cheap. I have a compelling reason to sort of take money out of cash and put it into equities now. I mean, I think a few years ago, as the housing bubble was taking off and going full bore, and as it was easier and easier for more and more people who normally couldn't have bought houses to go from renting to owning homes, residential REITs, apartment house REITs, were again, sort of on obvious historical measures, interesting, maybe even compelling. So you could buy apartment buildings for way less than it costs to replace them. You could, with public apartment REITs, you could get between a 5 and 9% current income component when interest rates were, down at 2 or 3. That was pretty compelling. Didn't, as sort of an asset class, and worked really well. Municipal bonds, right now, municipal bonds yield more than the equivalent treasuries, approximately 1.1, 1.2 times. That's pretty compelling. The only other time that happened was when there was sort of talk of they're losing their tax exemptions and tax rates were going down. Tax rates are going up. There's no talk about losing their exemption. That's pretty compelling.
Can I ask a follow-up?
Yeah.
You said individuals' default investment should be cash. I just want to point out that contradicts one of our readings. Jeremy Siegel, Stocks for the Long Run, says the default should be equities. Am I misunderstanding you, or are you?
I disagree with him. And Ben Stein, I think, is the only person who sort of agrees with me. He wrote a book, Yes, You Can Time the Market. I think, and he sort of basically says, only buy things when you have a good reason, sort of a really compelling reason to own them. I think, I don't know what he says about this, but I think most of the sort of equity, to me, the historic kind of case for equities is survivor bias. Is U.S.-centric, and it's survivor bias. Obviously, the U.S. went from a kind of average agrarian country to the industrial colossus of the world, and so obviously, or as a corollary to that, equities did really well. It's not, it's not. It's not 100% clear that, sort of over the next 100 years, that Asian might not, China, India, the tigers collectively might not surpass us, or the world might not do that well for the next 100 years, and the last 100 years in the U.S. don't really have that much predictive power.
We talked a lot in this class about, it's kind of correlated to about the equity premium. Can you talk a little bit about what you see as the advantages of bonds, why you focus so much on bonds and stay a little bit away from securities, and what advantages you think that gives you as an investor?
And here, I've convinced some people, though David Swenson really disagrees with me, and if you read his Pioneering Portfolio Management on the syllabus, he has a he really has a preference for equities. What I like about fixed income, I think fixed income is inherently more analyzable, because you have sort of specified coupons and maturity, a specified coupon and a specified maturity, and you have a fixed income. Either they pay you, or they have to reorganize, and they either pay you interest or they have to reorganize, and they pay you principal, or they have to reorganize, and it's inherently more analyzable. Stocks really have to be cheap because in general they don't pay out their earnings, and sometime in the future they're pretty apt to do something stupid, and they're you can't tell. On the one hand, I do think if there's a stock that is selling for 4, 5, 6 times earnings, and you have good reason to believe that the earnings are going up, something's when a stock sells for 4, mid-single-digit earnings multiple, the market is telling you that the market is saying that earnings are coming down. If you have good reason to believe that earnings are going up, if in fact you're right, in that case, when you buy the stock, you are making a bet on the earnings going up. And if the earnings go up, you'll get paid twice because the multiple will go up too. That's sort of the way things trade. When you if you buy something at a rim, the maker of BlackBerry sells for kind of 50, 60, 70 times earnings. When you buy that stock, earnings can go up. You could think, I'm buying the stock because I think earnings. You have to think earnings are going to go up, 12-fold to get it down to sort of 4 times earnings, which will take a long, long time. If you know earnings are going to double, you really don't know very much about what will happen to the stock price because if they're going to double over the next 2 years, hypothetically. If you're right on that, it doesn't matter because the multiple could very, very easily go from 50 to 25. So and in the end, they'll never pay you any dividends. So how do you collect? How do you ever collect a coupon? How do you ever get a hold of cash flow? So I just hate owning stocks. I love people sending me checks, which is what about. I think a couple of points. First, I do think it helps the world to have security prices that are closer to their accurate value than further away, and more tending towards their fair value over time than gyrating completely randomly. So if hedge funds could obsolete themselves, if hedge funds could make markets completely efficient, it would benefit the world a lot. is one, and so to the extent that they help make markets efficient, I do think they help the world. I do sort of agree. I think involved investors also improve the performance of the country's fixed assets, and that helps the world too. Hedge fund people aren't, and I think more and more that'll be a part of what hedge funds do. I mean, we gave it up, but we owned Sun Country along with the Petters Group, which is a Minneapolis-based point-to-point airline, competes with Northwest, and we, it was kind of an experiment, somewhat in behavioral economics, and we had distinct ideas about what their business strategy should be. We couldn't, and Petters and Whitebox actually did not disagree, but the Whitebox got completely disillusioned with management and wasn't, so we sold our stake to Petters. But if our ideas were good, it really would have benefited consumers in the Twin Cities, and I do sort of think that people who have sort of real money at stake are apt to, over time and on average, their ideas will be better than people who don't have anything at stake. I mean, activist investors, which are mostly sort of hedge funds, I think often, either make management better via competition, or on balance their ideas are right, and they certainly challenge, force management to at least consider alternatives. I think if I wrote in my last letter, I just read Paul Krugman's book, that the New York Times editorialist, the Conscience of a Liberal, and like a lot of hedge fund, I'm pretty free market, right wing conservative, but I think unlike hedge fund compensation is really a market result. It's the result of negotiations between informed parties of roughly equal economic clout and sophistication. Executive compensation is not the result of arm's length negotiations, and there's it's actually, I think, a Yale study on executive compensation. Something like 96% of Fortune 500 CEOs get their full severance package if they're dismissed for like anything other than a major felony. They can perform badly. They can be found to have breached their fiduciary duty, but they still get a lot. So I wouldn't. I'm on the hedge fund side and against the sort of company management side.
Could you tell the story with backdating of options
Um, um, and sure, we somewhat sort of the history when bonds are governed by what's called an indenture, which is the sort of legal agreement between the company and bondholders. In a typical bond indenture, if a company fails to file financial statements on time, that's an event of default under their bond agreement, and usually the remedy for an event of default is you can demand immediate payment, acceleration, and immediate payment. We in general, like people don't read every, people own bonds without reading the indenture. They're long, they're not written in English. In most set of circumstances, they are irrelevant. So we actually didn't really know this until we owned a bond in a company that did, that couldn't file their financial statements on time, and somebody else owned them and discovered them and demanded that they get paid, and ended up negotiating with the company, and we got a kicker. So that was kind of our first experience, thing that made us aware that not filing financial statements was an event of default, and therefore something that would entitle you to payment immediately. So for companies that could pay you back, but their bonds are trading below par, probably because they have a low coupon. So if bond was issued when interest rates were lower, they might have a 4% coupon when the prevailing rate is 6. So if it's a 4-year bond, it would trade at about 90, so it would be yielding 6. But if they default, you can, if you can buy them at 90, and if they can't file their financial statements, you're entitled to par. So we were interested in finding bonds, bonds trading below par, where we thought there was a chance that companies would not file their financial statements on time. And it turned out, at the time, one of the big causes of companies not filing financial statements on time was if they had backdated the stock options. They know what backdating is? If they had backdated their stock options, they'd have to restate their financials. They'd have to investigate, takes time, and so forth. They'd delay filing their financial statements. So we tried to identify companies that we thought had backdated their stock options. We bought a database. We cleaned it up, and we basically looked at their pattern of stock option issuance and tried to figure out the probability of it having been caused by chance. For companies that we thought had backdated stock options, that we could buy their bonds at what they would trade for without this potential event of default. That was kind of a riskless trade, because if they filed on time, we hadn't paid anything. If they were late, we had the prospect of getting par quickly. Later, in the very beginning, the sort of so the kind of history, there was the first trade where somebody else discovered that company couldn't file their financial statements because they had sort of bad record keeping or whatever. That one was not option related. So that first one was kind of happenstance. Kind of the next time, next couple of times, companies announced that they were apt to delay their financial statements. And the first few times, you could buy their bonds at the same price as before they'd announced that and potentially owed you par. But that did not, and here, in terms of sort of market efficiency, it didn't last forever. And after 3 or 4 times, companies would announce that they were going to delay their filings, and lo and behold, their bonds would go up because people had discovered that you might be entitled to par. So when it stopped working, like waiting, we tried to anticipate what companies might not be able to file and buy their bonds in advance. We gave the SEC our study and algorithm. They wouldn't tell us what their exactly who they were targeting and how. Though I got the sense that their approach was similar to ours, and they sort of seemed, even though they didn't say anything when we were talking to them, they seemed sort of pleased that when we did something, you could see when they were sort of pleased, and we took that to mean that was what they were doing, and they were sort of happy or thinking that got it right. As it happens, so far that we've been involved in, 4 companies have argued in court that failure to file financial statements is not an event of default. We won the first case, which we really thought settled it. We've subsequently lost 2, and one is pending. The wording is slightly different in all the indentures, but in general, we've settled 8 or 9 cases. Companies sort of agreed, and we negotiated a settlement. In terms of whether hedge funds are an instrument of social good or not. In the litigation, companies argue that we're opportunists, and we went in and bought more bonds after they filed late, and we haven't been injured, and it's basically unfair that they should have to pay us par. I did consider this, sort of noble work, because I think companies should honor their agreements. It's also the case that if a company paid off their bonds or settled them, they settled it for all bondholders and not just us. If anything, sort of other bondholders get to free ride on us. But I think hedge funds, sort of, and now, again, it's sort of a good thing if documents and agreement have meaning, and that requires active, engaged parties. Otherwise, the party that's active and engaged will take advantage of the other. The internet bubble, or more recently, the housing bubble, or not usually called this, but the lending bubble, where or the subprime mess, or so forth. Lots and lots of security loans, securities that people bought at par that were worth about somewhere between 0 and 15 or 20 cents, and now trade there. So I don't believe that markets are efficient, and it doesn't really seem like it should be an open question. So the people that believe it have to die, and then nobody will believe it anymore. Not very many of them change their mind, though they come up with more convoluted explanations. Clever, convoluted explanations for the counterfactual, for the things that happen in reality that the theory doesn't predict. So markets aren't that efficient. On the other hand, sort of doing better than the markets is a non-trivial exercise, and it's not as easy as it might appear, or as some people think it's impossible, other people think it's real. Where one public company owns a significant stake in another public company. And in instances where the one 3Com owned Palm, and the value of its Palm stake greatly exceeded the total value of the market capitalization of 3Com, and that persisted for a number of years. In general, less volatile stocks have done better over time than more volatile stocks, which is somewhat inconsistent with the notion of efficient markets. Lastly, there are a meaningful number of individuals and institutions whose sort of performance whose performance in portfolios is really inconsistent with the markets being efficient. It can't really be explained away by some of them can, but by luck or by inside information or by something. So while there's sort of a big academic debate, and then lastly, there are things like, sort of on one level, there are things like companies that have two different classes of stock that are economically identical. So Royal Shell used to have Dutch shares, Dutch shares that traded in Holland, and UK shares traded in London, economically identical, but their prices would fluctuate and fairly dramatically. In '98, I forget which way, but one of the share classes was at a 20% discount to the other, and that persisted for several years. So you have economically identical things trading at different prices. You have closed-end funds, which are vehicles that own a set of other securities, trade as a security, listed on the stock exchange, but what they do is own other securities. And whether they trade to a discount, whether the security in the closed-end fund trades at a discount or a premium to the stuff they own, fluctuates meaningfully in a way that's sort of difficult to recognize, with the idea that the security should be reflecting economic value. You have what are called easy. It's actually, not impossible, but hard, and there are a number of challenges. First, for individuals, I think the primary challenge is if an individual sticks to sort of areas where they might have an informational advantage, or at least don't have an informational disadvantage, they won't own a diversified portfolio of securities, because their informational advantage will be narrow. They also have sort of limited access to the gamut of products and so forth, and restricted assets and restricted access and restricted offerings. So that's a challenge for individuals. Institutions or sort of professional investors, all spend a lot of money on information, and which requires infrastructure and resources and so forth. But the very sort of nature of being an institution constrains almost everybody, whether it's I think the sort of first thing that I think most people think about, or the first question when you're thinking about financial markets, is whether they're efficient or not, whether they incorporate all known information, if it's possible to do sort of significantly better than the market as a whole. And I'm not sure. Used to be absolutely received economic wisdom that financial markets were efficient. Now it's I think it's still the dominant academic view, but there's a big debate, and there are partisans on both sides. It's actually, to me, it's actually a fairly simple question. The notion that markets are efficient derives from an a priori theory, which is the same sort of theory about all markets. There are lots of incentives, people acting in their own interest. They have to do that. It's a very appealing kind of a priori theory, but the thing about theories is they're supposed to make predictions, and if some of the things they predict don't come true, the theory has to be disregarded. And there are many counterexamples to financial market efficiencies.